Hello everyone, my name is Ding Lu. Today I'm going to do the presentation on what has worked in investing. It is a booklet developed by a Tweedy and Brown company, which is a very famous investment company. This is the overview of this presentation. First, I'll go over the background of the company, and then the investment characteristics mentioned in the booklet. And the third part will be the performance comparison, see if those characteristics will truly works. And the fourth part would be some personal views. So Tweedy Brown Company was founded in 1920. They first started as a security broker. They used the value investing philosophy as their investment philosophy, but the company start to picking up in 1957 when Mr. Knapp, who was the partner at Benjamin Graham's company, joined the firm. Benjamin Graham was the person, along with David Dodd, who developed the value investing philosophy. And as of June 30th, 2013, the asset under management of Tweedy Brown Company is approximately $17.4 billion. The value investing philosophy, basically it tells investors go for the margin of safety, go look for the margin of safety, and it was developed by Benjamin Graham and David Dodd, as I mentioned earlier. Famous value investors include Warren Buffett, Ron Barron, and Mary Gabelli, which, as you can see, this philosophy will provide you excess return and successful life if you stick to this philosophy. And 20 years performance comparison between the Tweedy Brown Value Fund and the market index FZ500 MSCI World Index. From the chart, you cannot really tell which one performed better over the last 20 years, but if you look at the table below the cumulative return, the value fund achieved almost 100% more than the world index, which tells you that the Tweedy Brown Company has done a significant good job over the last at least 20 years. So the reason I go over the background is to show that whether the company really did a good job. So if they did, the booklet, the material they provided will be worth reading. Otherwise, you don't want to waste your time on something that is not trustworthy. So these are the 5 characteristics mentioned in the booklet, which will help investors to identify undervalued stocks. There are PB ratio, PE ratio, inside accumulation, and recent price drop, and a smaller market cap. So the first, the low PB ratio, or the low price to asset value ratio. According to Benjamin Graham, the market value of the company should be less than 66% of the intrinsic value of the company. But in terms of their practical use, Tweedy and Brown believe it is of limited utility to the value investors, because intrinsic value should also include the company's PPE and its sales base. So there will be some adjustments. And this is one of the studies provided in the booklet, which to show that, as you can see, the lower the price percentage of the book value, the higher the average return for 4 holding periods. And if we look at the criteria that Benjamin Graham provided, the stocks also generate higher return compared to the higher percentage of the book value, which suggests that low PB ratio is a good indicator, might be a good indicator of the undervalued stocks. And then the booklet go on to provide studies to analyze the PB ratio, see whether the assumption, which is the good indicator of value undervalued stocks, holds true for a given period. The third characteristic is the inside accumulation, or stock repurchase done by the company. So the main idea here is for management, they have inside information about the company, and also they know the true value of the hidden assets. So when they believe the market underestimate the value of the company, they will start to accumulate their shares, or as a company to repurchase shares to maintain their stock a appropriate level. So that will be a good indicator for value investors to see if the management have I mean if the management has the confidence in the company. And then the fourth characteristics is the recent price drop. There's a nature law called the reversion to the mean. So when news come out and then the price drops significantly, it's a higher chance that the market value will be less than the intrinsic value of the company, and that's where the margin of safety exists. And for value investors, there will be a good opportunity to invest and then make profit. The fifth characteristic is the market cap. As we mentioned earlier, during the first and second characteristics, they all study the relationship between the low PE or low PB ratio between the market cap. During that study, those shows the smaller market cap, the better the return, because for smaller market cap companies, it is often with higher growth rate, and then for smaller companies, they are more easily be acquired by other big corporations. So when they be acquired by companies, and then the stock price will always will most likely to increase, which will provide a profit for the value investors. So now let's use some real example to see whether those characteristics really works. And here I just used the first two characteristics to show their comparison because it's more easier to measure. Here I have four value investors: Tully Brown Company and Warren Buffett, Ron Barron, and Mario Gabelli. And these are the stocks they invested. As you can see, if the small axis indicate that a stock meets that criteria. So for Tully Brown Company, most of their investments listed here meet at least two characteristics that I mentioned earlier. And for the rest, the three value investors, they have at least one characteristics met. So let's look at the performance comparison. Again, if you look at the chart above, you cannot really tell if whether the investors perform better or the market perform better, because sometimes they win, sometimes they lose. But if you look at the cumulative return below, you can see the value investors generate incredible return compared to the market. So again, you suggest that the value investing philosophy really works, can provide a significant profit to the value investors, to the investors. And then those characteristics are good indicators of undervalued stocks. Personal views. Bargain investment does not equal to investment with excess return. Here, the key is the margin of safety. If the investor does not find any margin of safety, or the margin of safety is not convincing, the investors should not invest. And the second is for undervalued stocks. These investment characteristics are usually associated with each other's. And also they are good indicators, but they do not guarantee a undervalued stocks. So you have to look beyond these five characteristics and to get more information about the company before you make final decisions. And the last is that it requires a very long period of time. So as we can see earlier, that over the last 20 years, you cannot really tell from the chart above that whether the value investors perform better or the index, the market perform better, because sometimes they win, sometimes one wins, sometimes one lose. But if you look at the cumulative return, value investors achieve amazing job. So it requires a very long period of time, you need to be long-term oriented instead of short-term, and you need to be very strict discipline to hold on to the long period investment goal instead of short-term. So it's very challenging for value investors. But if they can do so, they will have greater return than the market. So it is trade-offs. So that's my presentation. Thank you for this opportunity. Bye bye.